Vocabulary highlighted in the book The Basics of Understanding Financial Statements by Skonieczny, Mariuzs. 1. The balance sheet is a financial statement that shows what a company owns, how much it owes, and what is left for the shareholders in the form of equity. 2. The reason this financial statement is called a balance sheet is due to the fact that the accounting equation has to balance all the time. It means that assets must always be equal to liabilities plus equity. 3. Assets are classified into current assets, property, plant and equipment, PP&E, and other assets. 4. These items are listed according to their liquidity, meaning that the most liquid assets, such as cash, are listed first. 5. Current assets are part of the current asset cycle and are also called working assets. 6. Cash represents coins, paper bills, and on-demand bank deposits. Cash equivalents represent highly liquid, very safe, and short-term investments such as certificates of deposits, treasury bills, and money market funds. 7. 10 years, cash and cash equivalents constituted 5 to 7% of total assets, and this percentage jumps to 20%. This incident should be investigated more closely. 8. Even when cash comes from operations, the wisest course of action may not be to stockpile cash. It is the management's job to put it to work or return it to the shareholders in the form of dividends or share buybacks. 9. The accounts receivable account on the balance sheet represents the amount of money that the company's customers owe to the company. 10. Cash changes hands only when the customer actually pays. 11. It is important to monitor accounts receivable because a company may be reporting increasing sales, yet if it fails to collect accounts receivable, it could be in trouble. The state of the relationship between accounts receivable to total net sales could serve as a warning sign that something is wrong. 12. A sudden jump in accounts receivable in relation to net sales may mean that the company is having a tough time collecting from its weaker customers, or is extending credit to current customers in order to make its sales targets. 13. Inventory is what the company produces or buys to sell to its customers. 14. Inventory may consist of more than just finished products and is divided into 3 categories: raw materials, work in progress, and finished goods. 15. Depending on the business, a company's inventory could become obsolete. This is where management skills come into play. 16. Prepaid expenses are expenditures that have already been made for benefits that the company will receive in the near future. 17. Some prepaid expenses also result in cost savings, such as paying insurance premiums annually instead of monthly. 18. Property, plant and equipment, PP&E, is a term that refers to all of the company's assets that are not intended to be sold or resold to customers. Items in this account are also referred to as fixed assets. 19. When fixed assets are purchased, they are reported at cost on the balance sheet. Because they are expected to be used over many years, their expenditures are not charged against income during the year of purchase. 20. In general, because fixed assets are repeatedly used by companies to generate revenues, the more of these assets that a company owns, the more money it can generate. 21. The same concept applies to a business. If a business owns an asset that consumes cash instead of creating it, this asset is more of a liability than an asset, no matter how it is categorized by accountants. 22. Companies that have to keep upgrading and replacing property, plant and equipment assets just to stay competitive are in worse shape than those that can keep using these assets until they completely wear out. 23. They include items such as patents, copyrights, goodwill, trademarks, trade names, secret processes, and non-current receivables. 24. Liabilities represent what the company owes to various groups or businesses such as employees, suppliers, customers, creditors, and governments. 25. Current liabilities are the company's obligations that are due within 12 months. 26. Accounts payable represents amounts that a company owes its vendors or suppliers for which an invoice has been received. 27. One company's accounts receivable under assets is another company's accounts payable under liabilities. 28. For example, Walmart is able to sell many of its products to the end user and collect cash before it pays off its accounts payable. Suppliers are effectively lending money to Walmart for free, while Walmart turns around and makes a profit on this money before repaying it. 29. Accrued expenses are obligations to pay for products or services that are already received but for which an invoice has not been received. Once an invoice is received, an accrued expense becomes an account payable. 30. Income taxes payable is an obligation to the government. When a company sells a product and records a profit, a percentage of it needs to be paid as income tax. 31. Investors and analysts use a popular measure called the current ratio to determine whether the company has enough current assets to satisfy current liabilities. 32. A current ratio greater than 1 indicates that the company has more current assets than current liabilities. 33. A current ratio of less than 1 does not always indicate that the company faces liquidity problems. Some companies such as Coca-Cola or Walmart have current ratios of less than 1 because they can either easily access short-term credit or their earning power allows them to cover their short-term bills. 34. Long-term liabilities are the company's obligations that are not expected to be due and paid within 12 months. 35. However, as previously mentioned, not all debt is bad. If a company can borrow money at 4% and generate 20% profit on that borrowed capital, it benefits shareholders. 36. A quick way to check to see if the company has taken on too much debt is to compare its net income to its total debt. If it would take 20 years to repay this debt, a situation many airline companies and auto manufacturers are often in, it would not be a good sign. 37. Shareholders' equity is what is left after total liabilities are subtracted from total assets. 38. Investors may refer to shareholders' equity as net worth or book value. 41. Capital stock and additional paid-in capital represent the original capital invested into the business and any additional funds added later. 42. The retained earnings category represents profits that a company generated and did not pay out as dividends. 43. The balance sheet shows the assets that businesses own, liabilities that they owe, and equity that is left for shareholders. 44. If the business brings in more revenues than it pays out in expenses, it reports a profit. Otherwise, it reports a loss. 45. Revenues, also referred to as the top line, are recorded when the company earns them by either shipping the product or completing a service. 46. When investors examine revenues, two of the most important characteristics they need to look for are the quality and the dependability of the revenues. 47. While reading the full annual report is necessary, a phone call to one of the company's customers can shine a light on the dependability of a certain revenue stream. 48. Some businesses possess revenue streams that are more reliable than others. For example, cell phone or cable companies receive recurring monthly payments for their services. This type of income is extremely reliable. 49. A similar type of business is personal training. As another discretionary expense, customers can easily cancel or discontinue sessions. The cost of goods sold represents the direct expenditures associated with manufacturing a product. 50. The cost of goods sold represents the direct expenditures associated with manufacturing a product. 51. Under GAAP, companies must follow accrual basis accounting, which means that expenses must be matched with corresponding revenues. 52. a significant accumulation of products in inventory without a similar increase in revenues may mean that the company is unable to sell its products, and as a result, may need to write down the inventory costs through the income statement as a loss without a corresponding increase in revenues. 53. It does not include expenses associated with running the business, such as advertising, the management's salaries, and administrative expenditures. 54. Gross profit can be used to calculate the gross profit margin, which is useful for making side-by-side comparisons. 55. Companies in highly competitive industries and companies in weaker competitive positions tend to have low gross profit margins because they are forced to cut prices to stay competitive. 56. The pursuit to increase gross profit margins or prevent them from eroding was the main reason many U.S. companies chose to outsource their manufacturing activities to countries such as China, where labor costs are lower than in the U.S. 57. Operating expenses refer to the expenditures associated with operating or running a business. 58. They are the muscle that makes things happen. Operating expenses consist of selling, general and administrative expenses, SG&A, research and development, and depreciation. 59. The amount of SG&A expenses does not mean much by itself, but becomes more meaningful when compared either to total revenues or gross profits. 60. Generally, the best businesses spend fewer revenue dollars on these activities than their competitors. Some companies sell such a valuable product or service that they do not have to advertise much because customers do the selling through word of mouth. 61. Research and development expenses involve spending money to improve existing products or create new products. 62. One negative aspect of research and development spending is that companies in certain industries have to spend more on it than companies in other industries. 63. Depreciation is the gradual expenditure of fixed assets from the balance sheet onto the income statement. 64. At first, when a fixed asset is acquired, it is recorded on the balance sheet under the property, plant, and equipment account. Through depreciation, the fixed asset is gradually transferred from the balance sheet to the income statement as an expense. 65. Depreciation is considered a non-cash expense because the money required to purchase a particular fixed asset has already been spent. 66. The earning power of a company and compare it to its competitors. This kind of thinking is flawed. 67. Therefore, depreciation is a real expense and should be treated as such. 68. Companies that require huge amounts of fixed assets have high depreciation expenses. 69. Therefore, comparing the depreciation expenses of companies in different industries does not yield meaningful conclusions. 70. As a result, the depreciation expense as a percentage of revenues tends to be lower for stronger players. 71. Operating income is a profitability measure that is also referred to as EBIT, which stands for earnings before interest and taxes. 72. The operating income only shows the earning power of a company as if it owned all of its assets free and clear. However, this view is flawed because businesses borrow money to finance portions of their assets, and, as a result, they are required to pay interest, the cost of money. 73. The amount of interest expense is directly correlated with the amount of debt. 74. It is not unusual to encounter companies that show positive operating income before interest expenses are subtracted but are clearly losing money after interest expenses are taken into account. 75. It is not the actual payment of taxes, it is an estimated amount of money set aside to pay this expense in the future. 76. Net income is the bottom line that is achieved after all the operating expenses, non-operating expenses, and income taxes are subtracted from the revenues. This is the measure of the company's profitability. 77. in the majority of cases, an enterprise that consistently outperforms its competitors in terms of net profit margin may have some type of competitive advantage because it can either charge more for its products or control its cost structure better. 78. Companies that generate a higher return on equity than their competitors tend to possess some type of competitive advantage that allows them to generate above-average profits in relation to the shareholders' equity. 79. Earnings per share, EPS, is nothing more than net income distributed equally to all the available shares. 80. Basic shares outstanding represent the total shares issued by the company that are still outstanding. This line item does not include repurchased shares. 81. To be conservative, it is advisable to place more emphasis on the diluted earnings per share than the basic earnings per share. 82. For example, if the net income of a particular company is increasing at 5% per year, the management can accelerate the growth in earnings per share by repurchasing the company's shares, thereby reducing the number of shares used in their calculation. 83. Profits are very important, but they are not the same as cash, and cash is what is used to purchase more equipment, acquire other businesses, reduce debt, and pay dividends. 84. They can therefore be inflated when companies can afford to keep earnings out of the income statement and still beat earnings expectations in order to be used during lean quarters to continue to appear to meet those expectations. 85. Companies can either use cash or accrual basis accounting, but firms that want to be publicly traded in the U.S. are required to follow GAAP, which is synonymous with accrual basis accounting. 86. If all companies used cash basis accounting, there would be no use for the cash flow statement because it would be identical to the income statement and thus would be redundant. 87. Sources of cash include transactions such as selling products, borrowing from banks, issuing shares, and collecting accounts receivable. 88. The following are some of the questions that the cash flow statement answers. What were the sources of cash? Did the majority of cash come from operations or from the sale of fixed assets? Did the company borrow money or issue more shares to increase the cash level? 89. Cash flows in this category include cash receipts from customers from the sales of goods and services and from interest and dividends received from loans and investments. Cash outflows are cash payments to pay for supplies, labor, operating expenses, interest, and taxes. 90. Depreciation is the gradual transfer of fixed assets from the balance sheet onto the income statement due to the use of the assets and the passage of time. 91. When companies choose to sell some of their fixed assets, this may result either in a gain or loss included in net income. 92. A decrease in liability accounts, amounts owed to others, represents extra cash expended in that period to pay them down. 93. An increase in accounts receivable on the balance sheet would mean that less cash was received from customers, and a negative adjustment would be required to net income on the cash flow statement. 94. A company that can continuously use operating cash flow to finance acquisitions of new fixed assets, payments of dividends, repayments of debt, and repurchases of shares is likely making its shareholders wealthy. 95. Free cash flow refers to the cash flow provided by operations after the maintenance of the firm's productive capacity. 96. Replacement capital expenditures are those that only maintain the firm's productivity, they do not increase it. 97. Inexperienced investors often misunderstand this concept. 98. For example, some investors criticized International Speedway Corporation for having a negative free cash flow. If they understood the concept as it was just described, they would have realized that the reason why International Speedway Corporation appeared to have a negative free cash flow was it was spending a significant amount of money to add seating capacity to its speedways in order to increase the company's earning. 99. Acquisitions of other businesses can be beneficial to shareholders if they are consistent with the company's strategy and are accomplished at the right price. 100. Since it is not apparent for years whether an acquisition was successful, it is useful to analyze previous acquisitions to assess the management's track record. 101. It is acceptable for cash to be invested in short-term investments earning low returns until more productive uses for it are identified. 102. However, if the company experiences a negative operating cash flow, yet shows a positive investing cash flow, this is not a good sign because it could mean that the company is liquidating its assets to stay in business. 103. Cash generated through the sale of fixed assets is not sustainable. Eventually, the assets will be gone. 104. If the company has to spend the majority of what it makes from operations on replacing fixed assets in order to stay in business, this is not a good sign because it will not have any cash left for growth. 105. Companies in high growth stages are more likely to have positive cash flow from long-term debt because they tend to borrow to finance their current operations and future growth. 106. High growth companies are more likely to engage in issuing additional shares because their operations have not yet generated sufficient cash. 107. Share repurchases are the opposite of share issuances. A company that engages in share repurchases is spending cash, and therefore, the cash effect on the cash flow statement is negative. 108. It does not benefit the existing shareholders if the management repurchases the company's stock for $20 per share when it is only worth $5 per share. The situation becomes even worse when the management borrows money to repurchase overpriced stock. 109. High-growth companies usually do not pay any dividends because they are reinvesting every penny they make back into their businesses, and the rate of return on those investments is believed by management to be favorable. 110. If a company is earning enough money to cover the dividend, it is unlikely that the dividend will be eliminated. 111. A dividend cut can cause the stock price to collapse because investors who depend on the dividend income to pay bills are likely to sell it when the dividend is taken away. 112. Mature companies that pay dividends and repurchase shares tend to show a negative cash flow from financing activities. 113. If a business is generating a negative operating cash flow and a positive financing cash flow, they are engaging in an activity that is not sustainable in the long term. 114. By classifying them into cash provided or used by operating activities, investing activities, and financing activities, investors are in a better position to determine whether the cash is generated from renewable sources, such as operations, or non-recurring sources, such as fixed asset sales, and whether cash is being spent on acquiring additional fixed assets, making share repurchases, or paying dividends.